Every year, millions of Americans work hard, grind through long hours, only to hand over a chunk of their paycheck to Uncle Sam. But what if I told you? There are completely legal ways to avoid paying thousands in taxes, and the wealthy have been doing it for years? Pattern interrupt. Sudden switch to upbeat tone. No, I'm not talking about stashing gold bars under your mattress or fleeing to the Cayman Islands. I'm talking about IRS-approved strategies that anyone, yes, even you, can start using this year. Visual. Animated timeline of a person going from broke to wealthy, avoiding taxes step by step. Stick around, because strategy number 5 is one most people miss, and it could change how you think about taxes forever. Let's dive in. Let's start with the obvious one, that most people still ignore. 401k, Roth IRA, HSA, FSA. These aren't just retirement tools. They're legal tax shelters with serious long-term power. Visual. Side-by-side comparison. Person A pays taxes on $60,000. Person B only on $48,000 after deductions. Every dollar you contribute to a traditional 401k or HSA reduces your taxable income today. That means you're literally keeping more of what you earn. Pattern interrupt. Humorous question. Still prefer giving it to the government? Great. I'm sure they'll put it to good use. Like a $500,000 study on shrimp running on treadmills. Yes, that's real. Emotional trigger. Urgency. But here's the catch. These accounts have annual limits. Miss them, and that year's tax break is gone forever. Next up, a loophole the rich love, but barely anyone talks about. Imagine buying a rental property that goes up in value, but the IRS lets you pretend it's losing value and rewards you for it. Welcome to real estate depreciation. Visual. Animation of a home increasing in value, while depreciation deduction lowers taxes. The IRS lets you deduct a portion of a property's value every year, as if it's deteriorating. It's not magic. It's the most powerful non-cash deduction in the tax code. Own one rental? You could write off $3,000 to $10,000 plus dollars per year. Emotional trigger. Excitement. And here's the kicker. The property could be appreciating the whole time. That's like eating cake, losing weight, and the IRS congratulating you for it. Cliffhanger transition. But what if you don't have the money for real estate yet? No problem, because the next tax loophole doesn't require assets, just strategy. Start a side hustle, and you unlock a secret identity, a business owner. And with it, access to deductions employees can't touch. Visual. 2 people, one as an employee, one as a freelancer, showing the tax differences. Phone bill? Write it off. Laptop? Business expense. Home office? Yup. Driving to Starbucks to work? As long as it's legit. You guessed it. Deductible. Pattern interrupt. Playful tone. Ever bought a $3 coffee that somehow saved you $20 on taxes? Welcome to the club. But here's the serious part. If you earn just $1 from a side hustle, you can structure expenses legally through a Schedule C. Urgency trigger. This isn't a maybe. This is money people are losing by not treating their passion as a business. Still working that 9 to 5? Don't worry. There's a tax hack so advanced that even full-time workers can use it, with the right planning. Let's talk about your portfolio. Markets go up and down. But did you know your losses can actually cut your taxes? Welcome to tax loss harvesting, a technique smart investors use to offset gains and reduce taxable income. Visual. Stock portfolio losing $2,000. That loss offsets gains and reduces taxes owed. If you sold a stock at a gain, you owe capital gains tax. But if you sell a loser stock in the same year, boom, you cancel out the gain and maybe even deduct more. Humorous break. It's the only time losing money can feel like winning. Sorry, crypto bros, this might be the one silver lining. Emotional appeal. And here's the urgency. These strategies reset each tax year. Wait too long and your loss is just, well, a loss. Transition cliffhanger. But what if you could avoid paying taxes on your income? Forever? It's not science fiction. It's the final, most powerful strategy on this list. Here's a question. Why do people retire in Florida, Texas, or Nevada? Because those states have no state income tax. That's up to 13% of your income, gone from your tax bill just by moving. Visual. Map highlighting high tax versus tax-free states. Now imagine combining that with remote work, a side hustle, and tax-advantaged accounts. You could make $100,000 and only pay federal taxes. Want to go even further? If you work abroad and qualify for the Foreign Earned Income Exclusion, FEIE, you can exclude over $120,000 per year from US income taxes. Yes, legally. Pattern interrupt, joking tone. So if you've ever wanted to run a business from a beach in Portugal, now you have a tax excuse to do it.